Chapter 6, today we're gonna move to chapter 6, which is still dealing with accounting for the merchandises. Now from the chapter 5, with the purchasing and selling the merchandising items, we saw the process of purchasing, process of the selling. We saw that those processes are very similar in terms of when we're purchasing, we may experience discount, and when we're selling, we may give the client discount. We're getting discount because we want to pay early to enjoy certain percentage the cost of our inventory for merchandises that we purchase. Same thing with the client. Since we want to collect the money faster, we're going to offer discount so to make it more attractive to the client to pay earlier. The next thing that's going to happen is, in both cases, we may have a return and allowance. Return is when we actually physically return the item to the vendor, or the client return the item to us. In first case, when we purchase the item and we return it to the vendor, we don't have to pay for the item. When we're selling the item and the client return the item, then we're not going to get money for that item that we sell and client return. In the first case, when we purchasing, we're gonna ship the items back to the vendor, so we're gonna reduce our inventory. But when the client refused the items and return it to us, now we're gonna increase back the inventory. For the allowances, we don't have to do anything with the inventory. When we purchase it, we may get allowance, but we're gonna keep the inventory. When we sell it, we may give the client allowance, but he's going to keep the inventory. And the last thing that left was the shipping. For the shipping, when we pay the shipping, we have to increase our cost of goods that we purchase. When we're selling it, that will be freight related to our sales. So now let's keep going with this accounting for the merchandising and see what kind of system we may have to account for our items that we have in stock and the item that we sell. So the inventory, obviously, for the merchandising company and to some extent for the manufacturing company, will be the highest or significant amount of the assets. So now in the perpetual inventory system, we already saw the system itself tracking the purchases and sales. And the only thing that we have to do at the end of the period, we have to verify with the manual count is what we have in the system matching what we have on the shelves. If that everything is matching, then we can easily come up with the cost of the inventory that we're selling. And the cost of the inventory that we're going to selling will be the purchase price minus the purchase discount, minus any qualifying discounts. We're going to put any cost which we need for the items to be ready to sell, like a freighting or custom dues or insurance. And then we're going to get the inventory cost. Why do we need the inventory cost? We always need the cost because otherwise, how much we'll know to charge the client to cover the cost. So that's what the most important thing for the merchandising company is, to know the cost of the items that they're about to sell. Otherwise, they're never going to recover the cost. So we got that value of the ending inventory. It's also important because now when we get the value of the purchases and the value of all the items that we have in the inventory, when we deduct the one that we sold, we're going to get the cost of our ending inventory. Where those appeared on the financial statements. Now, inventory cost method. Based on the inventory cost method, let's see where we are. Based on the inventory cost method, we may have different calculations. Now let's see, we consider the 3 months period where the boxes of tea were purchased, including all the discounts and the transportation. So the first month we purchased for 55 each. Second month we purchased for 60 each. And the third month for 65. As you can see, the cost goes up. Now the question is, how are we going to assign the cost to the inventory that we're selling? And how would we know which one of those, since we're doing different purchases, which one of those items we have in our warehouse? Well, that will depend on the cost method. That's why it's very important we should choose the right method, which first gonna match our business, and second, we're gonna match the reality that we're living in. There are 3 methods here. First one is the specific unit cost or specific unit identification method. Now, when we say specific unit identification method means that every unit is unique and every unit is distinctive from any other. For example, one will be the car dealership, the other one will be art gallery, right? We have different paintings, which each painting comes with different cost. Obviously, when the buyer comes, he's not going to say, give me 10 paintings from Van Gogh. I want to buy 10 paintings for Van Gogh. How much is per painting? Right? That's not going to work. So he's going to go to specific painting and going to say, I want this particular one. How much is the selling price for this one? He's not going to ask you how much is your cost. He's going to ask you for his cost. Second one will be the first in, first out. First in is first out is the very straightforward method. Sometimes it's referred for the first in, first served. You may heard that term when we go into some places. Who comes first, he's going to get service first. Pretty much the same idea. So what that means? That means in our ending inventory, always going to have the last that we purchase. If the first one comes in, is the first one goes out. So whatever left in the inventory always will be the last one who came in. And the last one is the weighted average cost. Weighted average cost, obviously, we're going to see for the period how much we purchase as a number of units, how much cost us as a dollar amount divided by the number of units, we're going to get the weighted average cost. So let's see again for the inventory cost method. So what we're going to have here, each product has identical, except for the price per box. There are 4 shipments of the same boxes of golden gold balls during the period. They're stocked in the warehouse in our order of the arrivals in order from the left to right. 5 units were sold for 10, and the total sales for the period was 50. Now, if all the cases of goods available for sale for the periods are 2 plus 1 times $1, 1 unit times $2, 4 units times $3, and 2 units times $4, the total cost is 24. Now the question is, which units and how we're going to come up with the cost of the units that we just sold. Now, first one with specific identification. We have all those different boxes available. So when the client comes, he's going to say, I want one blue and I want one yellow. How much is the cost for him? Now for him, we're going to charge him the price, but how much we'll know which one cost us? We already know the blue one, since they're 2 times 1, the blue one cost us $1, and the yellow one cost us $3. The other option is if we sell one of $4, two of $3, one of $1, and one of $2. So basically, we're selling one blue, we're selling two yellow, we're selling one light blue, and one red. What will be the cost of each of those? We can easily come up with the, okay, since we have those available and we know that the blue one is the $4. So once he buy one blue, we're gonna cost will be $4. If he buy two yellows, in this case, that will be 2 times 3, $6. When he purchase one red, the only red, that's $2, and one light blue, that's $1. And we're gonna get the total cost. So what's left is ending inventory. Inventory, we have two yellows, which we know that we buy yellow for $3. We have one blue, dark blue, which is for $4, and we have one light blue, which in this case is $1. And we can easily come up with the cost of the ending inventory. So what we're gonna have is our sales are $50, we sell at $50. Cost of goods sold, 13. Why? Because again, we're selling one dark blue, two yellows, one light blue, and one red. We're gonna get our gross margin. Now the question is, how much is our ending inventory? Ending inventory will be $11. Why? Because only those one left, four left. We saw 1, 2, 3, 4, 5. In the beginning, as you can see, we have 1, 2, 3, 4, 5, 6, 7, 8, 9 boxes. 5 we sold, 4 left. With specific cost for each of them, we're done. That's specific identification. Now let's see the next one, first in, first out. Now, in this case, whatever comes first, that's what we're gonna sign first. Cost per each of those are irrelevant. So since we bought the $1 first, once we sell them, the first one that's gonna go will be the $1. Then we purchase one of $2. Next one goes is one of the $2. And then we sell. The next purchase is for $3. So two of the $3 go. So what's left in our inventory? The last purchases. How many boxes left? 4. So we have 2 from the last purchase, $4, and 2 from the second last purchase, which is $3. 2 times 3, 6, and 2 times 4, 8. So our ending inventory will be 14 in this case. We know that available was 24. So 24 minus 14 is going to give us cost of goods sold, which is $10. And the last method is the weighted average. On the weighted average, what we're going to do? We know that we purchased 9 boxes and cost us $24. 24 divided by 9, we're getting the cost per unit. Once we sell 5, we are assigning the same cost, and in inventory 4, it's going to have the same cost. So what will be the difference? Inventory. So let's see inventory costing now with the perpetual system. The inventory costing method produce different amounts for the ending and cost of goods sold. We're going to use those transactions for the following. First one, first in, first out. Every time when we have sell, we're going to take out of the units. Every time when we have purchase, we're going to add up more units. Make sense? So what will be our chart? So in order to picture it, what I'm going to do, I'm going to move to Excel spreadsheet and we're going to start working together with this data. Just give me a second to open up Excel spreadsheet and we can start working with this data together. Okay. We shall now spreadsheet with you. The good thing is today we're gonna have a track of our calculations on Excel spreadsheet, and you can use it later for you understand. On November 1st, month of November, we have a beginning balance of our inventory, which beginning balance consists of two things: number of units and cost per unit. And that's going to give us our total cost. Now, as you can see, the total cost is always mathematical function of two variables. What changing? The number of units can change and the cost per unit can change. And that's going to drive the total cost. So in our beginning inventory, we have 10 units. The cost for those 10 units is $10. And the total cost obviously should be $100. So we come up with that's number of units, that's the cost per unit. Let's put the cost, and that's the total cost. So we have our first beginning inventory. Then next, what we're gonna do is on November 5th, we're gonna make a purchase. Make those one bigger and wider so you can see them. On November 5th, we're gonna make the first purchase. We're gonna purchase 60 units, and the cost per unit is $11. That's gonna give us ending balance, the total purchase price, $660. So far, so good, right? Now, next thing that we're gonna do on November 15th, we're gonna sell something. How much we're gonna sell? We're gonna sell 30 units. We're gonna sell 30 units. And the cost per that we sell in this case is actually we're not worried about the cost. How much is the selling price in this case? We just know that actually we have the selling price. We're selling for $25. $25 is our sales. Then we have another purchase on November 26th. We're gonna get purchase, so we're gonna purchase 70 units. And those units that we purchase, they're gonna come with cost of $12. And then we have the last sale, which happened on November 30th. And the last sale, we're selling 90 units. And we're selling again for $25. Okay, have our information. I don't need this anymore. This one can leave it here somewhere later on for you to make a reference. And this is my basic information. Now, what I can do, my beginning balance is the beginning balance. I can highlight it in green. Then purchases is the one that's coming in. I'm going to highlight it in purple. And the sales that are going out, that's receiving my sales, I'm going to highlight it with that kind of pinkish color. Now I know at each event what's exactly happening. Purchase is purchase coming in, sales going out. Now, what we need to do here is to apply first in, first out. So in this case, that will be our basic information. First, we're going to apply first in, first out. What that means, whatever comes first, that goes out first. Now we have to ask ourselves the question. In the beginning, we have 10. Yeah, we have it. We have our 10. We have the cost per item. On the November 5th, we purchase another 60. The question is, how much we have available for sale? Because we don't want it for purpose of just sitting there, how much we have available for sale. And we can see that we have available for sale 70 units. What's our total cost? Total cost 760. Now the client comes and he wants to buy 30. And we say, okay, now we have a sale. And on November 15, I can easily actually copy this and put it here. On November 15, we make our sale. Great. How much we sold? 30. Now that sale comes with the cost. Make sense? So the question is, yes, our selling price is 750, but that sales. Now we're looking for the cost of goods sold. And how much is our ending inventory? That's what we need to know. After these sales, how much is our cost of goods sold and how much left at our ending inventory. As a number of units first, we have available 70. We sold 30. Our ending balance is going to be 70 minus 30, correct? Now, since we're applying first in, first out, whatever comes first goes out first. So what comes first? Beginning inventory. So first one will be to match the sales. We're going to take out the 10. The one that we sold is the first we're going to sell the pen at $10 cost. And the next thing that we're going to sell, sold items, we're going to sell, now that's 30 minus 10, 20. We need to sell 20 more, 20. And those 20 comes with the first purchase on November 5th at $11. So now, once I know that information, I can calculate how much is cost of goods sold. So my sales are $750. Now my cost of goods sold will be those two together. 10 times 10, that will be $100. This one time this one, that will be $100. And the next that I'm selling, another 20 items time $11. That's 220. So my cost of goods sold of this particular event is this one plus 220. My cost of goods sold 320. Now I can calculate my gross margin right there. My gross margin from selling those 30 items for $750 and cost me 320. So my gross margin is 750 minus 320. $430 is my gross margin. Now let's see how much is my ending balance, how much left after this sale. Available after the sale. So after my first sale, I sold 70. Sorry, I sold 30. I have 70. I sold 30. Now I have available 40. Which come from the purchase from November, and all of them comes at $11. Remember, when we're applying first in, first out. So what's left? From the 10 inventory, beginning inventory, I already sold them. Beginning inventory, go. From the first purchase, I'm selling only 20. How many left from my first purchase? The other 40. What was the cost for the first purchase? $11 per day. So how much my ending inventory? 40 times 11, 44. So after the sale, the first sale that they have on November 15th, after that sale, I still have 40 units, which comes from the last purchase, $11. So the cost for those is $440. Then I'm going to have another purchase. Then we're gonna add more. We're gonna add this 70. And now what we're gonna have available for sale. And we're gonna have available for sale those two. 110. Total, we're gonna have 1,280. Then we're gonna have the sale on November 30th. We're gonna have our sale. And I'm selling 90. That's my sales. 2,250. Now the question is, how much is my cost of goods sold? So since I'm selling 90 and I'm using first in, first out, the first that I'm gonna sell is the one who coming from the purchase from November 5th, right? From November 5th, I sold 20 on November 15, but I still have 40 more. So the first one's gonna come, those guys. That's what I'm gonna sell first. Right, that will be 40. After that, I need 50 more. From where I'm gonna get it? I'm gonna get it from the purchase that I made on November 25th, 26th. So I'm gonna sold 40, and I'm sold another 50. That makes it 90, correct? So now the question is, how much is the cost of those 90 that I sold? Well, the first 40 comes with the cost 440. The next 50 comes with cost $12 per unit, another $600. So it's gonna total gonna cost me 440 plus 600. That's gonna give me $1,040. That's gonna give me automatic contribution margin of $1,210. Now the question is, what's my ending balance at the end of November? Ending balance, inventory, will be in our ending inventory that my ending balance, the only thing that I'm gonna have is, since I saw from the last purchase of 70, I saw 50. My ending inventory left is only 20. And how much is the cost of those 20? Well, since they're coming from the last purchase on November 26, the cost is $12 per unit. And my ending inventory is gonna be 20 times 12. My ending inventory is gonna be equal, let's try again. This one times $240 is my ending inventory. And that's how I'm gonna end the month of, not this one, I need this one. Automatic, and this cover is gonna be like this. We're gonna highlight it and we're gonna do it double line, like this. Now, this is the longest way to do it. First in, first out. This is the longest way. And when you have, after every sales, you have cost of goods sold and you have the gross margin. So at this point, at any point of sales, you know how much is your sales, how much cost of goods sold, how much your gross margin, how many left. And purchase again, how much you have available, how many sold, which one you sold, how many left. And keep going, keep going, keep going. This is the longest way. The easiest way, we're gonna get this information. Okay, what we're gonna do? I'm gonna get the sales and I'm gonna put the cells together. One cell, another cell. I have the two cells. I have the beginning balance, and I have the purchases. So what that gives me? Well, that gives me available. Correct? So once I get all this information and once I run the total, I'm going to see that I have available 140 units at total cost of $1,600. My total sales and total sales are 120 units. Total sales price is $3,000. Now, from the 140 units that I have available, I sold 140. So 140 is my how much I have. From those 140, I sell 120. Now the question is, how many left? Well, that will be very, very, very obvious how many left. And we can easily say that what's left is our ending inventory. It's going to be whatever I have minus what I sold. And it's going to give me 20. Since I'm applying first in, first out, and I have only 20, most likely those 20 came from the very last purchase, which the last purchase is for $12. So my cost of goods sold at this point will be 20 times 12 or 204. That's how you can easily check yourself to see what you're calculating step by step. Is it equal to the simplest method by simply divided by the purchases and the sales and getting that. Make sense? Does this make sense? Is it difficult?
It's not too bad though, but it needs time to adjust a bit.
Correct. And we're going to have that time to adjust. So again, in the first in, first out, you're selling everything that you already had. And the ending inventory will be the very, very last purchases that you made. Now, let's get this and let me show you how the slide's treating this, the same problem that we just did. So what they're doing is exactly the same thing that we did. Every time when there's a sale, we're chasing the cost of the goods sold. And as you can see, the cost of the goods sold, the first one is since with the first sale, we're selling 30, we're selling the first hand that we had as a beginning inventory, and another 20 from the first purchase of 60. How many left? 40 left. What's the cost of those one left? Since they're coming from the very last purchase, which was November 5th at $11, $11 is the one, that inventory. Once we make another purchase of 70 at $12, now we have available for sale 110. Once we sell 90, first we're going to sell the 40, which comes with the November 5th purchase, and the rest 50 we're going to sell from the 70 that we purchased on November 26th. How many left? Left 20. What's the cost of those left? 204. What's the cost of goods sold? When we're going to check on the first sale how much we have, second sale what we exactly item we have, what's the item for the cost per item, and we're going to calculate the cost. And that's how we get it. Now, do you have to calculate it manually? Not really. Who's gonna do it for you? Inventory system. The inventory system is gonna keep track of everything. The only point is for you to understand, for me, you to understand is whatever left in the ending inventory comes from the very last purchase. That's how we should do it, nothing else. So again, with the first in, first out, the summary will be for the month of November. We purchased 140. We had beginning balance of $100. We purchased 1,000 items, 1,500. Available for sale, 1,600. And inventory 240, cost of goods sold 1,360. That will be the summary of what we did. As items, we had 10 in the beginning. We purchased 60 and 70, 130. And we sold 100 and with the beginning inventory 10, 130, that 140. We sold 120. We have 20 of them. Now, if we have to do the journal entry, at every cell, we have to show the sales, revenue, accounts receivables, and then we have to show the, first will be the purchase, right? We're gonna purchase the inventory, accounts payable. Then we're doing the sale, accounts receivables, credit sales, and since we're doing the perpetual inventory, right away when the sales happen, we're showing the cost of goods sold and reduction of the inventory. Then we make another purchase for 840. And then we make a sales for 2,250. Once we make that sales, we're updating the sales and accounts receivables. And after that, reducing our inventory and cost of goods sold. That's with the first in, first out. Now let's see. In the perpetual, we're going to have this moving average. Now, the moving average is interesting, but again, it's applicable only and only when we have that accounting software. What means moving average? Moving average with every purchase, the weighted cost of the item is going to adjust. How this is going to work? Let's go back to Excel spreadsheet and I'm going to show you. Again, the good thing is you're going to have this Excel spreadsheet. I strongly suggest you to use this Excel spreadsheet when you're doing your assignments. The other thing that I strongly suggest you is every time when you're doing your assignments in PSL, open the question on the Excel spreadsheet, do the Excel spreadsheet calculation and save that one. Why? Because you never know. You might have to use it or you may use it later. So to some extent, I'm going to use this information, but to some extent, not all of it. I'm going to delete all of those. So we're going with the moving average. What's going to happen with the moving average? We're going to have the same data, but what we're going to do is every time when we have a purchase, we're going to adjust the cost of our items. So how is this going to work? As I want you to understand something in the very, very, very beginning. We're not changing the date, right? In terms of, from out of this data, once we get the summary, we're always going to have this. Beginning balance, 100. Purchases, 1,500. And then we're going to have available for sale. And I'm always going to have available sale 140 items with the total cost of $1,600. Then I'm gonna total sales. Always gonna be 120. And the total sales always gonna be 3,000. Now, what will be my cost of goods sold and what will be my ending balance? That's a different story. That's what we're playing. Those are the numbers that we're gonna change. And we're gonna see now that my ending inventory in the weighted average gonna end up with different number. How much will be that number? We're gonna see in a few minutes. Stay with me, but I'm not gonna change the fact that I have 20 units available. 140 minus 120. I cannot change this. I know that I have 10, I purchased 130, available 140. I saw 120, I have 20. Now, how much is my cost of goods sold and how much is my ending inventory? That's a different question. In different method, different numbers. So let's go now with the moving average. What's going to happen? System automatically, you have to understand, automatically the system's going to start adjusting the numbers. Which numbers? System's going to know I have 10 times 10, $100. I purchased 60 times 11, 660. Total has 760. But I have 70 items. How much my average price per item? 760 divided by 70. My moving average is 1086. Now I'm selling 25. So out of those 70 that I have, I'm gonna sold 30. Gone. What will be the cost of those 30? My moving average, 1086. How much is my total cost of goods sold? 30 times 1086. So my cost of goods sold, in this case, is equal to this number.
Professor, we can see your screen.
Okay, sorry. Sometimes I'm getting too excited and I forget to share my screen. So let's go back again. Let's cover the missing parts. Again, we already know that my beginning inventory was $100. What I purchase is 130 items in total, with total cost $1,500. Total $1,600. That's my available for sale. What I sold is 120 items, $25 each, 3,000. What's left is the ending inventory. If I have 140 and he'll sell 120, most likely my ending inventory is going to be 20 units only. That's logical, correct? So now the question is, what will be my cost of the ending inventory? So since I have available, since I have my ending balance, I can get the cost of goods sold, correct? So let's go with this again. Let me delete those one and do the same thing with you now watching. First thing first, beginning inventory, I have it. $10, 10 items, $10 per unit, $110. Then I purchase 60, $11 per unit, 660. In total, I have $760 cost for 70 items. The question is, what's the average for every each of those? Then I calculated 760 divided by 70, 1086. So how much my unit sold? 1086. 30 units, 1086 is the cost. My total cost here will be 30 times 1086. It's gonna be 371. My half cost of goods sold, and I have my gross margin right there. Then what's gonna happen? I'm gonna have a new purchase. but now I have available. How much I have available now after the sale? I have 70 minus 30, 40. What's my average cost? 1086. What's the total cost? That much. What do you have now? I have new purchase. And that will be my purchase. So now, can you continue calculation at this point? Let me see if I can continue calculation for this point.
$58.
Okay, so let's see what we have available, right? After the sale, now it's available for sale. We have 110 units, as you can see, correct? And the total cost now is that much. Once we divided the cost divided by number of the units, 1158. Is that what you're getting?
Yeah.
Okay. So now, what's happened next? Next sale. Let's sell it. So we're gonna sell those 25 units. Sorry, 90 units at $25. We have our sales. And our sales gonna be 2,250. Now, cost of goods sold. We already know that we're selling. We know that we're selling 90, and the cost of those 90 is 1158. And then we can easily come up with the cost of goods sold, correct? And that will be our cost of goods sold. And the cost of goods sold in this case is that much. I can come up with the gross margin right there. Gross margin is gonna be this one minus cost of goods sold. And here the question will be exactly the same. So the point is, how much is our ending inventory? Ending balance of the inventory. As you can see, the number of the units then not gonna change. Right? We're still gonna have those 20 units, 110 available minus 90 that we sold, 20 units. But now our cost per unit changes to 1158, correct? So what will be our total cost for our inventory now? Is gonna be 20 times 1158, 231.60. So now if we have to compare with the previous one, so now we have ending inventory of 20, and this is the missing information that we need here. So our ending inventory balance is 1158, and the cost is 231.69. So as you can see, our cost of goods sold total, if we have to calculate the cost of goods sold, will be total available for sale minus ending inventory. That's how much will be cost of goods sold. What else we can see that cost of goods sold? I'll show you in a second. What else we can justification of our cost of goods sold? When we combining this one plus this one should give us 1,368.31, which is exactly 1,368.31. Now, if we go back to the first in, first out, now if we have to end up here with the cost of goods sold as well, again, we sold how many units we sold. Actually, the number of units in this case doesn't matter. because we know that we sold 220, but the cost of goods sold is interesting. Again, we're going to have available for sale minus the ending balance. Our cost of goods sold now will be 1,360. And now you can see how the information suddenly changes by using one method and another method. Why is important this? Because depends on the method that you're using. Remember, cost of goods sold goes to the calculation of the gross margin. So in this case, your gross margin will be 1,640. If you're using the weighted average, our gross margin will be 1,631. So as you can see, the gross margin going down. Why is going down? Because it's using the weighted average. So basically, every more expensive purchase that we're making, we're actually balancing the cost. So basically, in the weighted average, moving weighted average, our cost is a little bit more stable. Where in the first in, first out, when the price starts going up, our gross margin tends to be higher. Why? Because first we're selling the cheap units that we purchase in the very, very beginning. But on the other case, on the first in, first out, our inventory will be more expensive. You have, see, here we have $240 inventory, where you have here as an ending balance inventory, we have $231. So that's with the moving average. Let's go back to the slides and see how the slides gonna continue with us with that moving average. So with the moving average again, every time when we purchase, we have to adjust the cost, average cost per unit. Once we do that, we're gonna run the calculation, come up with the cost of goods sold, ending balance, and inventory on hand. They're rounding the numbers here, as you can see. That's why we're gonna end up with a little bit different numbers, but they're rounding the numbers. We're not rounding our numbers. On the journal entry, what's gonna change? Nothing. On the journal entries, nothing's gonna change. Only the number is gonna change. Debit and credits never gonna change. Again, first we're gonna purchase the inventory, debit inventory, credit accounts payable. Then we're gonna do the sale, credit sales, debit accounts receivables. And we're gonna write the inventory off by debiting cost of goods sold, credit the inventory, reducing the inventory. Then we're gonna make a new purchase to increase the inventory. As you can see, the purchases have the same amount, same value, they're not changing. What's changing is sales not changing. The only thing that's changing is cost of goods sold. And eventually the ending inventory is going to change as well. So let's compare here the effect and see the effect of both methods. What's going to happen is, if we're using first in, first out, our cost of goods sold are lower, which drives the gross margin higher. On the weighted average, when the price is going up, it's catching up the prices. So our cost of goods sold is a little bit higher and the gross margin is a little bit lower. But again, the ending balance of the inventory here, it's a little bit lower, where the ending balance of the first in, first out always will be higher if when the price is going up. So again, if the purchase cost increasing, the lower first in, first out producing lower cost of goods sold, high gross margin, higher net income, higher ending inventory. When the cost of the inventory start decreasing, we're gonna see the opposite effect with the first in, first out. That's where the whole thing comes, because again, what I want you to understand is the purchase is purchase, sales is sales. Now the question is, how are we gonna assign the cost of the item that you sell? And you have to be careful. You as a manager, if you become a manager one day, you'll be the one who's gonna decide which method to use. And obviously, if you go with the first in, first out, you always have to know that, and you have to keep track of the environment that you work in. If the see that the price is continuously climbing up, you may want to move to the moving average or weighted average. We're going to see later when the weighted average comes, because the weighted average is going to give you more stable income over the period of time. Where the first in, first out, the income always going to be a little bit higher, but it's going to keep more inventory. So if the prices go dramatically down, then you're going to experience less income on the next period. That will be the downturn. So accounting for the periodic inventory. This was the perpetual. Now let's see the periodic inventory. And as you can see in the periodic inventory, we don't have the moving average. We have the simple weighted average cost method. So what's going to happen with the periodic system? Remember, in the periodic system, we don't have accounting software to track all the information back and forth, what's happened here, what's happened there, what's happened here, what's happened there. So what we're going to do? At the end of the period, we're going to count what we purchase. We're going to see from the invoices what we sold. We're going to come up with the ending inventory. We're going to physically count the ending inventory. We're going to see how many units we have. And we're going to come up with the calculation for the cost of goods sold and ending balance. So how this is going to go? With the cost of goods sold, remember, in the periodic system only. What we're going to do? We're going to get the beginning inventory. We're going to add the purchases. We're going to deduct the purchase discount, purchase return allowances, because in the periodic, we keep it in the separate accounts. And we're going to come up with the net purchases. If we pay for the freight, we're going to add the freight up. And then we're going to see how much we have available for sale. We're going to deduct the ending inventory. And we're going to come up with the cost of goods sold. So basically, we're doing the same thing, but a little bit backwards with the totals. So now, which makes it a way more easier. So that's why usually, if we have to do this now, and we have to do the exam on paper ever in this exam, in this course, I'm not asking you to do the moving weighted average. Moving average is good when you have a computer, when you have Excel spreadsheet, and the following the calculation and following the order, everything easy. But with the periodic system and weighted average, that's the one that I like. And that's what I'm asking you to use, because you can easily get it. So what's with this one? The very simple thing. What we have to do? We have to see how much is the beginning balance. We have to see how much is the purchases. We have to see how much is available. Ending inventory, cost of goods sold. And every time when we have sales, we're just making records for the sales. Only for the sales, not the cost of goods sold. We're not matching cost of goods sold with sales in the periodic system. When we're going to do cost of goods sold? At the end of the period. And then we're going to show the ending balance. So let's go and do this and show you in the Excel spreadsheet how simple this one is. We already did it. You don't know yet, but let's do this first in, first out. That will be, let's change the name here. That will be perpetual. And moving average, we know the moving average is only for the perpetual. And then I'm gonna copy this, I'm gonna move it here, and I'm gonna change it this periodic. And now I have to share my screen, I believe, right? Because I didn't share my screen. And now you have it available. So now I changed what I did is I changed the worksheet to have the proper names. So now what we're gonna do is when we're doing the periodic system, one thing that I want you to understand. These calculations that we did for the period perpetual, we don't need it. So I can easily delete it. So what we're gonna do? We're gonna get the beginning balance. We're gonna get the purchases. We're gonna have how much we have available for sale. Once we get available for sale, we're gonna count the ending inventory. Now, on the ending inventory, we already know. That's where the things come in the first in, first out. On the first in, first out, you already know. If I have 20 units left in my ending inventory, what will be the cost of those 20 units? Is it possible? Now, I want you to answer me with the voice rather than the chat, or maybe in the chat. Yeah, I'm gonna monitor the chat. So in the chat, I want you to tell me, is it possible those ending balance, if I'm using first in, first out, that 20 units that I have in my ending balance to be from my beginning inventory? Is it possible? Is it clear for everybody that is no way my ending inventory balance when I'm using first in, first out to be out of my beginning balance? Second thing, if I have only 20 and my last purchase is 70, is it possible my ending balance to be from the purchase from November 5th? Is there any way to have out of those 20 somewhere on the purchase on the November 5th? No. Now, question, and let me, I'll change the number for a second. This is only for the purpose of this question. If my ending inventory is 80 now, let's say pretend that my sales less, my ending inventory end up with 80 units. Now, is it possible in my ending inventory, I to have items from the purchase from November 5th? Yes. Makes sense? Now it makes sense, correct? Why? Because my last purchase is 70. So I definitely am going to have the 70, plus I'm going to have 10 from the previous purchase. Great. Okay, good. Now you're getting it. So for that reason, for the first in, first out on the periodic, we're going to get the beginning balance, we're going to get the purchases, we're going to get the sales as a number of units. We're going to come up with the cost from the last units left in our inventory, which will be 12 from the very last purchase. And we're going to get manually cost of goods sold. Done. We're done with this. Now let's go with the weighted average. Weighted average is even easier. Weighted average, that will be periodic. Now, what I'm going to do is weighted average. I'm going to delete this and I'm going to show you. Everything going to delete so I can start from scratch. So what I need the beginning inventory. I need first purchase. I need the second purchase. And I need available for sale. I know the number for the units. Those are my number of units. I know my total cost. Then I know my sales. I have sales on 15th and I have sales on 30th. I know my total sales. Correct? Now, what I know is my ending balance. And my ending balance is whatever I have available minus whatever I sold. Now, what I want from you is tell me what's my average cost per unit. That will be the average cost for my ending inventory. Tell me how much is my total ending inventory and calculate me cost of goods sold. Cost of goods sold, again, is going to be available minus the ending balance. You have to come up with the cost of goods sold. Let's see if we can do this. Now I want you to do it by yourself, and I'm going to catch you again. What you guys get? What's the average cost here? What you get as average cost?
I got $11.43.
$11.43. Excellent. So what will be our ending inventory cost? $11.43. How much will be the total
Times
ending inventory?
20.
$228.57. How much is our cost of goods sold now? Is that what you're getting? So now tell me honestly, which one is easier? Weighted average or first in, first out in the periodic system?
Average seem easier.
It's just, once you assign the cost, it's just the cost, right? So do you see the difference now? All right. Excellent. I'm gonna give you a break now. Let's go for a break for 10 minutes or 15 minutes. And then we're gonna start after the break. We're gonna start doing questions only. So I want you to practice for the purchases, calculation of the cost of goods sold and any inventory in both perpetual and periodic and closing entries. That will be the big questions for the materiality. If you lose $5, would you be able to sleep tonight? If the answer is yes, that means $5 is not material for you. If the answer is no, that means $5 is material for you. And technically, materiality is determined by the amount which normal user of the financial statements changes his decision or normal decision that he normally is going to take. And once he see that the number is actually different, he changes his decision. Consistency, again, consistency, keeping the same period, the same method, first in, first out, or the weighted average over the period of time. Disclosure, you always have to disclose which method you're using and how you're using it. Accounting conservatism is about you to showing a number which is not too optimistic. That's why we're applying this accounting conservatism. Later on, we're going to see in accounting, we even have the we evaluating the inventory for the lower of cost or net realizable value in order to apply this accounting conservatism. One by one, if you have to go, consistency, the sales of the business should be the same, and the support of the objective communicate useful information. The company must report any changes in the accounting method that they use. So if you're changing from first in to first out to weighted average, you have to disclose this is accounting changes that you have to make. Disclosure is related to the appropriate disclosure to the financial note of financial statements, enough information for the readers, and it has to be information reliable, relevant, understandable, and comparable. So technically, if you're changing the method of inventory, your accounting information is not going to be comparable. This means we have to disclose it, the value of the inventory, different categories of the inventory. So now if you have, we haven't talked about this yet, but if you have a manufacturing company, in the manufacturing company, you're going to see the raw materials, you're going to see work in process, and you're going to see finished goods inventory, which we haven't talked yet, but we're going to go to that point as well. Materiality again is it's the level of mistake for which we're going to make your decision maker change their decision. And accounting conservatism is related again, that it should be reported on the amount of the least or the amount that leads to the most cautious immediate results. In terms of if you're thinking that the price that your inventory is sitting on your inventory account is too high compared to the current market price, you have to adjust it right away. Other issues that we have to talk about those are the lower of cost net realizable value for the inventory. Again, once you feel that the inventory is overpriced, you have to lower it to the lower of cost net realizable. Effect on the inventory errors, estimate ending inventory, and ethical issues. So for the net realizable, I'm going to leave this one for the intermediate accounting people when they come, when they catch you. They're going to chase you for the net realizable, lower cost of net realizable. The only thing that I want you to understand is you have to choose between lower of two items. That's why lower of cost net realizable seems like a term, but actually it's not, because you're looking for the lower of two. First one is cost, and second one is net realizable. So now we have to see which is the cost. Cost is a historical cost. What net realizable? Net realizable will be how much you can sell it, less anything that you have to pay for the sale. So on the errors, I'm not going to spend too much on the errors here, not until we do some questions. I'm looking for some calculation of the gross method. Now, the calculation of the cost of goods method, this is used when you have to estimate the inventory in the case of the destruction of or to prepare monthly financial statements without completing the physical count. So what we're going to do, we're going to get the beginning inventory. We're going to add the purchases. That's going to give us available for sale. We're going to deduct the ending inventory. And again, we're going to come up with the cost of goods sold. And for this reason, this is the gross method inventory that we can come up with. And the retail method, I'm not going to chase you on the retail method. The only method I'm going to chase you is the gross margin, gross profit method. For the gross margin, I'm going to explain this in class. This specific method, I'm going to explain it in class so you can understand it and we can go over this. So for now, let's go over some questions. Let's do some questions together now. Enough with this slides and enough with this theory. Let's go with the practice. practice is always better than the theory. I don't know if you agree or disagree, but that's how I find it. Because when we're doing questions, you're exposed to the journal entries. And when you're exposed to journal entries, you have an opportunity to make mistakes, which mistakes are good for you. Because every time when you make mistakes, you're actually going to learn. If you don't make mistakes, then I don't know. What do you prefer to make how do you learn usually? By making mistakes or not making mistakes? Which one is better for you? To
Of
make
course,
mistakes
make
or not to make
mistakes.
mistakes? Sorry?
Of course, it's making mistakes in a safety zone.
In the safety zone. Well, it doesn't get any safetier than here, especially in the classroom. You understand this? In the classroom, that's a safety zone. Why? Because you already pay for the mistakes. You don't have to pay again. So what we're doing is just making mistakes. I gave you some materials, didn't I?
Yes, from last class.
From last class. You get a lot of materials. So now let's start working on those materials. Let's go first with, I'm going to share one document first. Let's go with this. We have to insert the letter of each term in the blank space besides the definition in the most closely matches. So what will be agreement that the ownership of the goods is transferred to the buyer of the business? Do you see anything here? So the agreement that the ownership of the goods is transferred at the buyer's place of business. That's something with the free on board, but is it in destination or shipping point?
Would that be destination?
That will be destination, yes. How about the time period in which the cash discount is available?
Discount period.
Yes. The difference between the net sales and the cost of goods sold.
Would that be margin profit?
Yes. That will be gross profit here.
Oh, gross profit, sorry.
Gross profit, right? A reduction of the receivable in a receivable payable that is granted if paid within the discount period. That will be probably purchase discount,
Discount.
right? Or this
Oh, yeah.
or sales discount, purchase discount, sales discount, or depends whether we receivable or we have to payable. Purchase description, purchaser's description of the cash discount received from the supplier of goods.
Cash discount.
Agreement that the owners of the good is transferred at the seller's place of business.
FOB shipping point.
Shipping port, okay? Reduction below the list or catalog price that's negotiated in the setting a selling price of goods. That may be trade discount here.
Trade discount.
Now, the seller's description of the cash discount granted to a customer in return for early payment.
Sale discount.
Sales discount, okay? The time period in that can pass before the customer payment is due. That most likely will be credit period,
Credit
right?
period.
The goods that the company owns and expect to sell to its customers. That will be G, right?
Yeah, inventory.
Merchandise inventory. Okay, you have the answers after, or that will be at the back of the paper if you still have the paper with you. Let's go with the next one. Next one is mostly calculation. Now, why I'm giving you this question seems like a super easy question, but I want you to get comfortable with this simple calculations, okay? See where they have it. Try to share it again. This one. So, again, sales minus cost of goods sold is going to give you the gross margin, correct? Minus minus operating expenses is going to give you operating income. Make sense? Do you see anything difficult here? Can you guys hear me?
Yeah, pretty straightforward.
That's very straightforward. It should be very straightforward. There's nothing scary here, right? Because the gross profit you can get at the sales minus the gross cost of goods sold. Sales minus the gross profit, you're going to get cost of goods sold. Once you have this, you can get this. Now with here, you have the net income is not loss. Operating expenses is 93. So now you can come up with the gross profit from sales. Right? Once you get the gross profits from sales, you can come up with the cost of goods sold. Here again, you're starting with the net loss. From the net loss, those two, you can get the gross profit. Once you have the gross profit, you have the net loss, 5,500. You can easily come up with the operating expenses. Here again, working backwards. You have the net income, you have the operating expenses, you should be able to come up with the gross profit from sales. Then you come up with this number. And the last one will be net income loss minus plus the operating expenses, going to give you the gross profit from sales. Deduct the cost of goods sold, you should get the sales. Or actually, in this case, you have to add the cost of goods sold. Sorry, you have to add the cost of goods sold to get the sales. Okay, next one. Question number 3. It's question 3. Okay, this one is now purchasing and selling. That's more interesting now. I'm going to move this one to Excel spreadsheet. And we can start working with this question. So what we have to do on this question is we have to require this. We have to show the records of those transactions from both sides of the companies as a purchaser and as a seller. So let's go with this. Let me share my screen. Okay, can you guys see my screen? Let's make it bigger a little bit. Let's make it here a journal entry. David, that will be one, that will be another one. And this one will be our debit here. That will be credit here. Let's start one after another with this question. First one, the company purchased, this company purchased under the following term. 1,800 invoice price, 215 and 60 free on board factory. The cost of the merchandise for Alpha company is $900. So let's go first with which point of view? We present the entries from the beta point of view. But the beta point of view is the company that we are. We purchasing beta purchases from Alpha under the following items. So now let's go with the purchase. That will be in March. On March 2nd. What's happened on March 2nd? We are now in beta. Beta Ltd. They purchase inventory and they haven't paid for the inventory. That will be debit inventory. And they haven't paid for the inventory, so that will be credit accounts payable. And now we have to see what's the debit, what's the credit. Remember, debit and credit has to be equal. So make sure they're always equal, debit and credit. This, so the inventory that they purchased is $1,800, and accounts payable is $1,800. Let me format this to be as a number sign, both columns here. Okay, and we have our first journal entry. Next one, paid shipping, 2,000 shipping charges. As you can see, the boat company is using perpetual inventory system. So every time when they pay shipping, everything's going to go to the inventory account. Don't forget that. Shipping for the charges for the purchase on March 2nd. So let's pay those one. That will be March 3rd. That will be 3rd. And then we're going to have debit inventory. With the shipping cost is 125, and then we're going to pay cash most likely. There it will be cash, 125. And we're done with this. Next one. We have to return to Alpha Company unaccepted merchandise that had inventory price of $300. The cost at Alpha is 165. So basically, we're returning from our purchase inventory for $300. So that will be on March 4th. We're going to have debit accounts payable because we're not paying for those which we return. That will be 300 here. And credit will be inventory, correct? With another 300, we keep it in balance. Okay. Send a check to Alpha Company for March 2nd purchase, net of discount and return merchandise. So how much is the net amount? Our inventory is 1,800, but we reduced 300, so 1,500. On 1,500, if you pay within 15 days, we can use 2% discount, correct? So on March 17, what's going to happen on March 17 now? We're going to pay. Now what we're going to pay? We're going to pay debit accounts payable, and we're going to close the entire accounts payable, which will left $1,500. Are you guys with me? $1,500 we're going to pay it. And how we're going to pay it? Credit will be cash. Now we have to see how much cash we're going to use. Now, first, let's get because we're going to use this purchase discount, 2% of the 15. And once we do that, we're going to reduce our inventory. And that will be reducing with 2% of 1,500 is going to be 0.02 time 1,500. We're gonna get $30 reduction in our inventory, and we're gonna pay the remaining, which is gonna be equal to this one minus the $30, and we're gonna get the payment. Now that's for the beta company, right? That's what this company is gonna do. Now the question is, in this case, the question is what the company on the other side is gonna do. Now let's see what the other company is gonna do. Alpha Limited. Let's go with Alpha Limited, and let's go now. What Alpha is doing is they selling. So on March 2nd, they selling. Okay, if they sell and we're not paying, they're gonna debit accounts receivables for $1,800 to matching our purchase. Now, as you can see, my accounts payable matching the accounts receivable. Make sense? One company has to pay $1,800. The other company has to receive $1,800. Why? Because this company sell credit sales of $1,800. Now they're doing the sales, but that sales comes with cost. So now we have on March 2nd, we have to do the second entry, which is gonna give us the debit of cost of goods sold. And our cost of goods sold cost us $990. And then we have to credit, since we remove it from the inventory, we have to credit our inventory and reduce the inventory with $990. And we're done with this. Now this company pays shipping, but since we're selling, we're not part of the shipping thing, so nothing for us. On March 3rd, the company decided to send back something. So on March 4th, the company is sending. So if the company is sending, we have to give them some sales return and allowances. So we're gonna debit sales returns and allowances with $300. So our sales gonna go down with $300, and credit, since we're giving them, they don't have to pay. Accounts receivable is gonna go down with $300. That's great. Now what's gonna be the next one? Now we have the items, right? They send it to us. Now we have to put it back to our inventory, debit inventory with 165, and we have to reduce our cost of goods sold with 165. Okay, that's perfect. Now March 17 comes and we receive the cash. That will be March 17, and we're getting the cash. Now the question is, how much cash we're gonna get? Well, exactly the cash that the other company pays. How much they pay? They're paying 1,470. Well, that's our cash. That's how much we're gonna get. We may wish for more, but that's exactly how much we're gonna get. We're gonna get $1,470. Why are we getting that? And with that amount, they're closing accounts receivables for, as you can see, our accounts receivable 1,800, but we're reducing 300. So they're closing accounts receivable $1,500. So what's happened with the rest? We need more debit. Debit's gonna be, I need debit, and that debit will be sales discount. And I'm going to give them the sales discount of $30. So if we have to compare everything, so let's get this alpha thing. Let's put it in different color, so we can distinguish one from the other and make it like this. So now, if we put it side by side, what we're gonna do? Whatever the accounts payable for one company is accounts receivable for the other one. Now for us it's inventory, but for them it's sales. Now they don't have the inventory. That inventory goes with them. So the next thing is my accounts payable goes with 300, their accounts receivables goes down with 300. Why? Because I'm not using that inventory and they getting the inventory back. But with the inventory back, they give me that sales return and allowance. The last one is the cash. Whatever cash they pay, that's how much cash I get. And because they have a reduction in the inventory, that comes with me with the sales discount. Their accounts payable is my accounts receivable, so they can match each other. So that's when you're comparing side by side, you're gonna see that there's a lot of logic in everything that we do in accounting. So whatever it's payable for one company is gonna be receivable to the other company. Whatever one guy's giving you, that's how much cash coming to you. Questions with this question? That was question 3. Do you see anything scary here? Tell me something, guys. Can you guys hear me? Can you still hear me? Yes. Okay. It's different in the class, right? In the class, we can see each other. You can tell me what you like, what you don't like here. That's kind of tricky. But we have the Excel spreadsheet. So now, having this in mind, having this experience, I want you to think and let me know next time, which one is better for you, to do it on the Excel spreadsheet or we to do it in the board? Think about it and let me know next time, okay? Because I know to some extent you're missing this opportunity, you to do everything on the Excel spreadsheet. I know the other group, with the other group I'm doing the entire lecture on the Excel spreadsheet. And after that, I'm posting that Excel spreadsheet so they have it available. But with you, it's different story. The question 5, now the question 5 is something similar to question 2, I believe. But in that question, let me share my screen so you can see it. On this question, we're asking for different information. So as you can see here, in this first one, why I want you to do this question and get comfortable with this question? Because this part here, this particular part, is basically calculation of the cost of goods sold for the periodic company which is using periodic system. Because you have the purchases, when you know the periodic system, they're using the different accounts for every single activity. For the purchases, one account; for purchase discount, separate account; for purchase return allowances, different account. They're all different accounts. So this calculation is going to help you to understand how cost of goods sold are calculated in the periodic companies using periodic inventory system. And the next one is pure calculation of now on the sales part. Here with the calculation of the cost of goods sold, where here it's basically on the sales part with having the sales discount, sales return allowances, and other expenses here. Again, I believe this one should be straightforward. There should be nothing scary here. The question that one more question that I want to go over today is let me see if I can find this question. Of the closing entries on the periodic system, which is question number 6. So this company, let me share my Excel. So I had to try to look at the Excel spreadsheet. I lost it somewhere on my screen. Let me open it here and share it with you. Okay, on this question, I'm gonna paste it here. Not this one. Sorry, wrong pasting. This one I wanted to paste, to copy. This is the question that we have now. This company has those accounts which they have balances. Now, what we have to do is we have to close this entries. We have to do the closing entries. As now, the thing is, once we see this kind of information, I want you to get a little bit comfortable with this and start thinking, now what kind of information and what kind of company first is this? Only by seeing the accounts. As you can see, this company has a cash, accounts receivables, inventory, prepaid rent, inventory ending balance, equipment. Only those two inventory beginning and ending, they should tell you that this company is using periodic inventory system. The next thing that we can see is this company has the sales revenue, sales discount, sales return allowances, purchases, purchase return allowances, freight. And then we have the expenses. So definitely this company using periodic system, since they have all those different accounts at the same time. So what we have to do, we have to close all those accounts. How are we going to close them? Very simple. First thing first. On the first stage, what we have to do is we have to close sales revenue. That was our first. And then we can see what else we have with the with the credit balance that we have to close. And that will be the purchase return allowance. That will be our first closing entry. Second one will be we have to close the expenses, which we're gonna close those expenses. That's number 2. Plus, we're gonna close everything that also have debit balance, which is sales discount, sales return allowances, purchases. We're gonna close all those as well. Now, once we close all this, the next thing that we have to do is to close the beginning balance and open the ending balance for the inventory account. Maybe I should go with a different color here. Let's go with green color. Once we do this, that's number 3. Once we do that, then we're going to check the income summary account. Once we close the income summary account, the last thing that left is to close the withdrawal account. Let's go with that color. That will be our very, very, very close to number 5. So let's start one after another. Let's first close the revenue and everything that has credit balance. Closing revenue plus debit credit balance accounts. So first thing what we're gonna do, debit. If we have to closing the sales revenue, we have to debit the sales revenue. So that will be debit sales revenue And we're gonna credit income summary. Let's go here, credit income summary. We're closing everything in the income summary account. But we also have repurchase return allowances. Let's close those one too. Debit, purchase return allowances. And again, credit will be income summary. So what we have for the sales revenue, I'm gonna make those one bigger. And for the sales revenue, we have 835,400. For the return allowances, 1,600. So the total will be this one plus that one. And we're done. 837. That will be what our first entry to close the revenue and credit balances accounts. Next one, we have to close expenses and debit balances accounts. Let's go. Where are we going to close them? We're going to close everything in the income summary. And starting credit. First, we're going to close freight in. Second, we're going to close utility expenses. Then we're going to close amortization expenses equipment. Then we're going to close this miscellaneous expenses. And then we're going to close all those accounts with the debits balance, which we want to be end up with zero balance. Sales discounts. We're going to close sales return allowances. And we're going to close the last one with the purchases. So let's put the amounts in those accounts. So the freight in is 1,200. The utility expenses are all those amounts. Then we're going to have sales discounts, which is 10,000. And all the other amounts. And the income summary is going to end up with getting sum of all these accounts, all these amounts, all of them. So that's how much going to go to the income summary account. Now, the next thing that we have to do is to close inventory, beginning balance, and open inventory, ending balance. How are we going to do this? The beginning balance is debit. So we have to credit it and debit income summary. So what we're going to do? We're going to debit income summary. And we're going to credit inventory, beginning balance. So the income summary, the inventory beginning balance is going to be that much. And the income summary is going to be exactly the same amount. And now we have to open it. We have to debit inventory, beginning balance. Sorry, that will be ending balance here. And we have to credit income summary. So my beginning balance, my ending balance that I have to have at the end of has to be 351, and income summary is going to take the same amount. And we're done with this. The last thing that left, the one more thing left is the next one. We'll be closing income summary. So income summary, what we have to do for the income summary? We can open the income summary account and see what's debit and what's credit there. In the income summary account, as we can see, and this is debit, and this is credit on the income summary only. So income summary, on the first entry, we have this amount which comes on the credit side. On the second entry, we have this amount that's coming on the debit side. Then from the inventory on the debit side, we have new amount, which is 345. And for the another inventory ending balance, we have 351. So we're gonna run the calculations here. And we're gonna see what the difference is. So our difference is we need something on the debit side. So how much I need on the debit side? I need this amount on the debit side in order to bring the balance to zero. So what I have to do, I have to debit income summary. With the amount of 417. And I'm gonna credit now owner's capital, which is for the same amount. And the last thing that left is closing withdraw account. And the withdrawal is gonna be debit owner's equity, capital, sorry. And that will be, make it here appropriate. It's capital and here owner's capital. And we're gonna close it into credit will be withdraw account, which withdraw is for 53,000. So the 53,000 capital goes down and 53 comes here. And that's how we closing company that running periodic system, not perpetual, periodic system. Now for the perpetual system will be a way easier because in the perpetual system, we don't want to see this freighting purchases, purchase return allowances. We're just going to see the sales discount, sales return. That's all. Which make it, and we don't have to open and closing the inventory balance. So that's why I prefer to show you this one. And next time in class, we're going to practice for the periodic system. That will be closing. That will be question. I believe that's question 6. And that's where we're going to end up today. Now questions.